In this episode, I have an interview with Tim Brennan. He has spent years involved with various aspects of the Unitarian Universalist Common Endowment Fund. This is All-in-One Financial with Bill Holliday. We discuss financial planning issues of investing, taxes, estate planning, insurance, retirement planning. This is brought to you by AIO Financial, a fee-only financial planning firm working with clients all over the U.S. and expats all over the world at aiofinancial.com. Thank you for joining me on this episode. Tim, he has served as the Treasurer and Chief Financial Officer for the Unitarian Universalist Association. He's been part of the Investment Committee, the Socially Responsible Investing Committee, Retirement Planning Committee, the UUA Health Plan Board of Trustees. He's led the UUA's shareholder advocacy efforts, pressing for companies to address issues such as climate change, BGLTQ rights, political spending, and corporate governance. Tim came to the UUA after 7 years with Ceres, C-E-R-E-S, a network of institutional investors working to advance corporate responsibility for the environment. All right, let's go to our interview.
All right, Tim, thank you for joining me on this. I appreciate your time. I did see your bio. You have a lot of good experience, and how long have you been with the Unitarian Universalist Common Endowment Fund?
Yeah, well, I've been with the Unitarian Universalist Association since 2006. And the UU Common Endowment Fund is a program of the association.
And could you just describe what that fund is and who it's for?
Sure. It is a investment fund. It's a highly diversified fund, structured the way a lot of endowments and foundation pools are. And it's available to UUA organizations, primarily congregations, and of course the UUA itself. So all of our congregation are independent entities. We came out of the 19th century free church movement. And so each congregation makes its own decisions about how it wants to manage their own assets. And many of them have chosen to invest their endowments in the Common Endowment Fund alongside the UUA's endowment. So right now it's roughly $200 million, and about half of that actually belongs to congregations, and the other half is the UUA's endowment.
Gotcha. So can individuals invest in this, or it's just for congregation?
Yeah, it's just for institutions because, we are exempt from most securities laws, are prevented from taking the assets of individuals for that reason.
Yeah. All right. So it's for each congregation to decide if they'd like to pool together and use your resources.
Exactly.
Wonderful. What kind of mix of investments do you have? Do you invest in funds, or what type of holdings?
Yeah, well, it's as I say, it is highly diversified. So it's like a university endowment. So it includes U.S. equities, large cap, small cap, international equities, emerging markets, a variety of fixed income strategies, some alternative strategies, private equity. All in, I guess we probably use about 25 different managers that we employ across a whole array of different strategies.
Okay. And how is performance compared to broad index?
Well, I'm not sure index makes sense, because it is so diversified. So you couldn't go buy this anywhere. We benchmark against like-sized endowments. So our investment consultant, which is New England Pension Consultants, all the consultants pool data anonymously, and so they benchmark us against endowments in the $50 to $250 million range, and we pretty consistently do very well. Upper quarter. Some periods we do great and we're in the upper 10th decile, but pretty much consistently, I'd say upper 30%.
What constraints being this endowment versus like a personal investor? Do you have a longer time horizon or less concern about volatility, or you're open up to different investment options? I mean, how would it vary your portfolio?
Well, I guess a couple of things. One is, except for, a quite wealthy individual, you couldn't get the diversification that we are able to offer the congregations. And because we're dealing with a fund that's $200 million, which is not huge, of course, by, pension fund standards, nevertheless, it's enough that we can get pretty good fees. So, fees tend to step down as the investment goes up. So, our positions might be 5 million or 10 million with an individual manager, and that allows us to get pretty good fees. And the other thing is, by working through the investment consultant, we're actually able to get into certain funds that might be precluded from either smaller investors or investors who are just working on their own. Because in the same way that we pool investments and we're dealing with a $200 million pool, they're working on behalf of all their clients, which is north of $1 trillion.
Gotcha. So this is actually probably more relevant to individual investors. Just how are you using your investments to make changes? I guess to start off with, just what values are driving your decisions?
Yeah, so I would say that our investment committee brings UU values to bear in every investment decisions. So there are 7 core principles that undergird Unitarian Universalism, and those are considered as we make all of our decisions. Now, that doesn't say that every single investment we make or every single fund is all we would want from a values perspective. But, over the years, we have gotten to the point where I'd say over 80% of the portfolio is managed with environmental, social, and governance issues integrated into each and every strategy. So that it's manager selection, and it's also security selection. So let me just give you a little specific example. On the U.S. equity side, we have mostly separate accounts. So that means we actually own the individual stocks. We hire managers to pick the stocks, but we own individual stocks. One of the strategies is entirely passive. So we've hired a manager who specializes in passive investments and asked that manager to create a portfolio for us of stocks that replicates the Russell 1000 value. But we said we also want you to incorporate ESG data, that's environmental, social, and governance data. We use Sustainalytics, and take that data and integrate it into the model. So this company, they don't know what fundamental research is. I mean, there's nobody on the floor who knows anything about it. It's just all, an optimizer, a computer program that creates these portfolios designed to replicate the index. But they have put this data in there, and they said, would replicate the index, but in each industry sector, skew the portfolio towards better ESG performers. Now, the interesting thing is, and we've been running this strategy for well over a decade. The interesting thing is this strategy outperforms the index, even though it's designed to replicate it. And it outperforms 1, 3, 5, 7, 10 years. So when people tell me, if you do ESG investing, you're going to lose money, I say, here's real world data. It's not the case. We have, at least met in every period, at least met the benchmark, if not exceeded it.
So you're taking, like in this example, you're taking the index and saying, if they say 10% is in technology stocks, you're taking 10% in technology. But then when you're selecting your companies, you're not going to necessarily pick the index companies. You're going to look at ones with environmental, social, governance records that skew or are better, better records.
Yeah, it's a weighting.
Those you found have tended to outperform companies
Correct.
with lower environmental social governance records.
Yes.
I mean, that
Yeah.
can, I mean, there's some logic to that. You'd hope that's true,
Yeah.
that more responsible companies would end up doing better, but that's great to see that's your experience too. So how about on shareholder advocacy? Do you have some examples of what issues, or have you felt you've made an impact through advocacy?
Yeah, absolutely. So on advocacy, we have a long history. The UUA was a co-filer of the first ever shareholder resolution on a social issue. It was in the mid 60s. It was at Eastman Kodak. And the resolution focused on the fact that Eastman Kodak was almost all white in Rochester, New York, which is a largely African American city. And so this resolution asks for the company to take action to give opportunities to people of color in the company in the mid 60s. It was co-filed with TIAA and United Church of Christ, among others. So we have a
Right.
long history in shareholder advocacy. When I joined in 2006, a member of our socially responsible investing committee was Jim Gunning, had a long history in shareholder advocacy. He went back to the very first meeting that some people from World Council of Churches had about apartheid in South Africa. And out of that grew the Interfaith Center on Corporate Responsibility and all of that work to end apartheid. So in my time, so before I was at the UUA, I was at Ceres, which is an advocacy group that organizes investors to work on corporate sustainability, so environmental issues, and particularly there was a lot of focus on climate change. Which is one of the reasons they selected me, was because they wanted that expertise and they wanted to grow that part of our activities. So yeah, so over those years, we've done a lot of resolutions, a lot of engagements with companies, and have frequently succeeded. So, I mean, I could just give a couple recent examples. Well, let me go back a little bit more. So one thing we worked on for several years was asking companies to incorporate protections for GBLT people and also protect gender identity and expression in their non-discrimination policies. And I think when we started this, there were about 30% of the S&P 500 that had those policies. And now it's up into the 90s. So it's not just us. There were a lot of investors working on this, but we saw many companies after a year or two of pressure say, "Okay, let's talk about this." I actually had one company, a big insurance company, we filed the resolution. I get a call from the assistant corporate secretary, and the first words she said to me were, "Thank you."
Oh, that's great. But you see the shareholder resolution really making some big impacts.
Yeah, absolutely. More recently, we've done a lot of work on lobbying and election spending transparency. And just this year, we filed a resolution at BlackRock, the largest asset manager in the world, because we thought their disclosure around lobbying was unclear. And actually, we filed for 3 years. And this year, third year, and we had a lot of conversation with them. This year, they agreed to do most of what we wanted. And so we decided to withdraw the resolution. And so they added a specific language to the board charter, assigning a particular committee to monitor this. They disclosed all of their trade associations that they support that do lobbying, and other things too. So that was very good. Then we filed a resolution on election spending at Monster Beverage, and they said to us, "Well, first of all, we don't do much. This is not relevant, so we're not going to do it." And I said, "Well, that's okay. We'll just see what the shareholders think at the annual general meeting." And 2 weeks later, I get an emailed report. "Is this what you're looking for?" And it was. It was about 80% of what we wanted. And we said, here's the other 20%. That came back like another 3 days later, with a
Oh,
commitment
that's
to review
fabulous.
this report every year. So,
That,
yeah. So yes, we've seen a lot of change driven by shareholder work. And I don't want to act like this is the UUA working on its own. Shareholders have have power by working through coalitions. So the Ceres Coalition, the Interfaith Center on Corporate Responsibility, ad hoc groups working on election spending, the Center for Political Accountability, all these different groups that we work through by pulling together shareholders and getting a common agenda. That's what really drives the change.
that makes sense. But that's interesting. The Monster Beverage example, that's a real threat. They don't want this to be as public, or it would be better for them to just say we're doing the right thing and not have an argument. No, that's super. And yeah, that makes sense. So some of the organizations you work with, or you work with groups to bring more power to each issue.
Yeah, on the climate side, there's been talk that somehow you can't use shareholder leverage with oil and gas companies, that there's just such an inherent conflict between fossil fuels and climate change that there's no point. But we've seen very significant changes coming from the oil and gas industry. I mean, I'll just give one example, which is Devon Energy. A few years ago, they were heavily invested in the Canadian oil sands and also in deep water exploration. We and other shareholders have been making the case that, that's if you assume that the world's going to take some action to limit climate change, those are very risky investments. So in the case of Devon, just about a year ago, well, about 3 years ago, they got rid of their deep water. And about a year ago, they got rid of their oil sands investments. And now they're in investments where they can easily be throttled down if need be. And that's exactly what happened now. And they're in much better shape than a lot of companies because they don't have these commitments to extract oil and gas over such a long period of time. They can throttle it back as either conditions, markets, or regulation requires them to do so. And that's what we're looking for, is really for the companies to be nimble. We do need oil and gas right now, but we want it to decline as fast as possible. And when it does, we don't want investors holding the bag. We want companies that can be nimble and turn down that throttle very quickly. So I think a lot of companies are moving in that direction.
Yeah, that's interesting. That's actually ties in with my next question is, how do you weigh that screening with advocacy? Because there's some companies you want to make changes in, but it may not be seen as a responsible company to be holding. I guess, how do you balance that?
Yeah, so that's a good question. So in the case of Devon, and I would also say Conoco, those companies are, the best of the bunch. And a lot of the right stuff. Conoco, for example, has a very progressive policy on engaging with Aboriginal peoples where they're doing exploration, so that they engage these communities long in advance of ever investing $1 in the ground to make sure that it can work within that culture. But then there are other companies, I would say Chevron and Exxon are in that category. And in those cases, we have a little pool of money. I mean, it's not much. It's a couple $100,000 out of 200 million, where we buy small pieces, small holdings, enough that so if we want to engage the company through a shareholder resolution, we can. And for instance, in the case of Exxon, we've been filing there for a few years on election spending disclosure. And I don't have such a happy story there about the outcome. They have been really resistant. Although, the vote went up again this year pretty significantly. We're up over 30% now. But yeah, so So we can selectively engage with some companies by just having, $5,000 worth or something. You need $2,000 to file a resolution. So we'll have enough. We'll set it aside in that fund, and it gives us some leverage. And we're able to be at the table when there's an engagement with the company. So we do find it useful. And even in a case like Exxon, we've seen movement there. I mean, they spoke out last year against the Trump administration overturning the methane rules. And that was pretty powerful to see. And it came right out of a dialogue meeting. We were sitting at the table. It's actually me. I'm not taking credit, but it was my role. I said, we really. So we're talking about methane and regulation. They said, well, we support that. We're okay with federal regulation of methane leakage. We said, well, you got to say it. You've got to speak out. Within a week, they had a press release from the president saying we oppose the Trump overturn of these proposed overturn of these regulations.
That's great. That's got to be satisfying, seeing some immediate results from that. I sometimes think too, holding a company, I mean, if you buy some company on the secondary market, especially quietly, you're not really making an impact. Whereas the engagement, I mean, that's where you can make an impact. So just having something in your portfolio, it doesn't mean you're voting for that by having something there. It's I think it's definitely worth it to have it if you can influence that company.
So in the case of the UUA, we had a resolution at our General Assembly several years ago that instructed us to remove fossil fuel companies from the portfolio, but it made a clear exception that said, except if we are engaged with the companies on the issue of climate change. So we were already light on those companies because, obviously they have environmental flags. And so many companies in that industry sector were already not in the portfolio. And then over the 5 years of that resolution, we reduced our holdings significantly. We ended up with a handful of these companies where we are actually engaged with them. So we've held on to those. But it is the case that we have really pretty dramatically moved away. And it turned out to be great, right? So this has been a great time to get out of oil and gas because it's been
a great
rough
financial move for sure.
And I have to say, now when I engage with these people, I mean, I feel bad for them. It's like, oh my God, what an industry you're in. It's terrible.
Yeah. No, they've got a tough road ahead too.
Yeah.
How about the third pillar there? We did screening and shareholder advocacy, community investing. Like, what are some examples of that you do through the fund?
Well, we do a fair amount. Back in the 90s, what was then the Social Investment Forum recommended that its members allocate 1% to community investing, which we did. And we have done ever since. So it's a couple $1 million. And we have invested in things like, microfinance through, Oiko Credit, although they're no longer working in the United States. A lot of community funds, housing funds, what's called Blue Hub now, which used to be a Boston Community Fund. So we've invested in a lot of different things. More recently, a couple of interesting ones in Boston, the Ujima Fund. So this is a fund that invests in tiny local businesses in communities in Boston that are predominated by people of color. So Roxbury, Mattapan, and Dorchester. And they actually have members, just people in those communities who then vote on the investments, what they think they want in their community. It's a very interesting model. So we love those people. Boston Impact Investors is another fund. It's kind of a ratchet up from that. Still smaller businesses, still Boston focused, but investing primarily in companies led by people of color and women. I mean, a construction company led by a woman in her 30s. It's really interesting. A lot of great work. So those are two new ones that we're pretty happy with. But the other thing I need to tell you, which I think is very important, is that after I stepped down as chief financial officer, I wish it had happened before, but it happened after. The committee decided to increase the allocation to community investing from 1 to 5%.
Oh, wow. How has that been as an investment? The purpose of these community investments is providing capital to people who otherwise might not have access or might only have access at a higher rate. So you're kind of offering below market. Has that turned out to be a good investment?
Yeah, I would say yes. So it's interesting that in 2008, 2009, when the world was coming apart and it was being driven by subprime lending. So that's exactly what community investment funds do, right?
Right.
It's subprime lending. It's people who normally would not qualify for lending who are given loans for houses or businesses or whatever. So through that period, we did not see one default in our portfolio.
Wow.
Our
Just
high
the
yield,
good
our
screening
high yield,
or
yield portfolio, on the other hand, had lots of defaults. And those are the professional Wall Street investors. And it's because it's done in such a different way. It's very personal. They don't just lend money. They're really trying to help these people. They're trying to give them tools to manage the money. They pay a lot of attention to every individual loan. I mean, I had a meeting with one bank that did a lot of community lending this time. And I said, so how's it going? And a couple guys sitting at the table said, hey, Dave, remember, have we had any defaults? What about that, the fund over in, or the loan over in Dedham, Massachusetts? Yeah, that one is a little troubled. We think there'll be, they know their borrowers.
yeah.
So anyway, it turned out to be great. So we sometimes accept what's called concessionary rates, which means that you're lending the money at a lower rate than you might get in the market. And so, I don't know, when when a treasury is paying a little north of 1%, I'm not sure what concessionary is. But in any case, some of it is more, quote unquote, market rate. But overall, it's performed well. No defaults. Everybody's paying their interest on time. And it's a small part of the portfolio. Now, as it expands,
Right.
I think they'll look at other kinds of investments in that space, investments that may be, more explicitly market rate investments. So it'll still be good for the investors in the fund. It's not like we're going to be giving away a bunch of money, but it's going to be investments that are going to have a clear positive impact on communities.
Oh, that's great. I mean, I think community investing is that's a big impact that investors can have through providing capital. But it sounds like you do a variety of domestic and some international with that portion.
That's correct.
No, that's great. And then any thoughts about just the screening making any impact? I mean, shareholder advocacy clearly makes an impact. Community investing, there's lots of good examples there. Screening, I could see just taking the risk of some of these irresponsible, like you're saying, if responsible companies are outperforming, the screening could actually help performance. As far as making an impact, any thoughts on that?
Yeah, so I think the real driver behind the screening, the negative screening, is just aligning your investments with your values. It's how you feel about making money. And, if we screen out tobacco companies. I'm sure that no tobacco executive has lost a nanosecond of sleep over the fact that the UUA does not invest in their company. That said, I think that there has been such a shift in the market over the last decade, and particularly the last 4 or 5 years, with so many more funds now explicitly integrating ESG, that my own belief is that is now moving the markets. So as we skew our portfolio towards better ESG performers and other investors, big investors, BlackRock doing the same thing, I believe that lowers the cost of capital for those better performing companies, ESG performing companies, and raises it for the poorer performers. So as the market shifts, as ESG is integrated more deeply into larger and larger funds, in that sense, I think that screening does have a role in putting pressure on companies to be better ESG performers.
That's a great point. That's a great, because I mean, just for retail investors, there are lots of options that just screen and don't engage. I kind of think of them as a different tier, but that's nice. I mean, that's a nice thought that still helps the team in some way, make some changes.
So I won't say the name of the company, but I was engaging with an oil and gas company recently, and I was dealing with the corporate secretary, and he said to me, "Don't tell anybody this, but the stuff that you guys are pushing us on," he said, "I just had a meeting last week with BlackRock, and they were pushing us on exactly the same stuff." So BlackRock does it more under the radar. They tend not to vote for the shareholder resolutions. But what he told me was, "You're filing the shareholder resolution asking us to do X. BlackRock is calling us on the phone saying, you need to do X." But not supporting the resolution. And what BlackRock says, well, when we lose patience, when we don't see movement, then we'll vote for it. So my point is that many companies, investment companies that you can go through, are actually engaging these companies over similar issues that you're concerned about. And and a place like BlackRock is pretty transparent about what their priorities are. So even there, you're having some impact. And other funds, you probably they're not doing it. So there is a distinction there.
And this is probably shifting. I'm sure you've noticed there's just so much more data available that 10 years, 15 years ago, 20 years ago, it wasn't, as you weren't able to see this much information on these different issues. I think that really wraps up my questions. Anything else you want to add? Sources for people, or if they have further questions or want to get engaged, anything you want to direct people to?
Yeah, I mean, I think as far as resources go, if you're interested in issues like climate change or other environmental impacts, CERES, which is CERES.org, they have tremendous resources on their website, reports on companies and ratings and that sort of thing. If you're a faith-based investor, or even if you're not really, the Interfaith Center on Corporate Responsibility has tremendous resources on their website. That organization is really all about engagement. The UUCEF, which is the Forum for Responsible Investment, they have great resources, really a lot of good stuff for retail investors on their website.
Fabulous. All right, that's great. Thank you very much, Tim, for your time. This was really helpful.
Sure.
Oh, no, this was good. This was really good. Thanks a lot. I appreciate it.
Sure. You're welcome. Thanks. Bye.
Take care.
Thank you for listening to AIO Financial. This has been brought to you by AIO Financial. If you need help with any part of your finances, please contact AIO Financial for a free meeting, AIOfinancial.com. We do have a free ebook about SRI, or an introduction to sustainable, responsible impact investing. It's a free ebook, and you can find it at impactfinancialplanners.com/SRI ebook. I really appreciate any comments, questions you have for us. Any feedback is helpful. You can comment where you find this. You can go to AIOfinancial.com and there's contact information. Feel free to email, call, write. If you like these videos and podcasts, please subscribe to our channels and rate our content. It'll make it easier for other people to discover this information. All right, thanks a lot. Bye.